back. As I mentioned, we have Dan O'Reilly here from Sterling Financial. Well, welcome. How are you?
Good to be here, Lisa. How you been?
Good, good. And
we're in for a hot week.
In for a hot week. Yes, we are.
Yeah.
Yes, we are. And it looks like the stock market is not very hot.
Well,
it is very cold, and there's so much volatility going on. That
Friday was a bad day. It
was
kind of pinched us a little bit.
It did.
August in general has been good, but Friday was not a good day.
No, it wasn't. And it's starting off kind of crummy this morning, too.
Exactly.
But you know what? Let's talk about some good things that are happening for people who want to save money. So first, let's start off with what is the 10-year treasury yield? What does that mean, and what is it?
Well, the 10-year treasury is kind of the benchmark that people use as their bond portfolios and things like that.
Okay.
Obviously, over the last year or so, it's gone up because interest rates have gone up.
Right.
I think I've got a slide there that says it was like just under 1%.
Yes.
In 2020, it's up to 3.4% right now.
Yes.
And that significantly impacts, obviously, people who are buying bonds, but it impacts those that had bonds negatively. Okay. CD rates have gone up as well. They've gone from 0.5% all the way up to 2.5% right now.
Right. Can I ask you a question about that?
Sure.
Because I think what's interesting to me, and I always thought that CD rates should be higher than they are right now. What are the CD rates based on?
Well, CD rates are based upon what the bank can invest their money for. So when you bring in $100,000 to them, they sit down and they probably plug in their profits and everything, and then they have money to invest, and they go out and invest in car loans and home mortgages and things like that. Unfortunately, everybody, insurance companies, banks, they lower rates a lot faster than they increase rates. Okay. So, but if you look at that, I mean, I think the 10-year treasuries is a little over 3%. The CD is 2.7.
Yeah.
That kind of matches that for right now. But there's an inversion right now that shorter term rates are higher than long term rates, which generally isn't the case.
Yeah.
The 2-year treasury is probably 3.5%, where the 10-year treasury is 3%.
Okay, I see.
So we have that little bit of a dynamics where you have short-term rates higher than long-term rates.
Yeah. It's really interesting, and I think some people seem a little perplexed by it.
Well, when I let's assume that I bought a bond 2 years ago that was yielding 2%. Kind of works like a teeter-totter, okay? Where if interest rates go up, the market value of my bond goes down because people would rather buy new bonds at 4% than I have a bond at 3%.
Yep.
So the market adjusts that and lowers my market value of my bonds, so it kind of yields what the current bonds are doing.
Okay.
So over the last year and a half or so, bonds have been pinched as well as the stock market, so it's been kind of tough to be in a safe place.
Yeah, and I'm sure many of your clients probably come to you and they're asking exactly the same questions that we're asking you. Is, what do we do? The stock market isn't doing so well. We want to have a safer plan.
Right.
So I would imagine that you incorporate some of these bonds.
We do. You don't want to have everything in cash. You don't want to have everything in the market. We've talked about this before. There's certainly a lot of different options. You probably want to go out and get some cryptocurrency, right?
Thought about it, but not yet.
Bitcoin, there's a lot of people that think that's the next wave, but waves crash as well, and so you need to be careful on that. And especially as we get into retirement, you don't want to have that money exposed to a lot of risk. Exactly. But I still have clients that want that big return, and so you're in the market and you're going to see some volatility.
Right. People
that want a little bit safer return probably ought to be looking into more. They always talk about a 60-40 split in the market.
Yes.
60% in equities, 40% in bonds. The problem with that 60-40 scenario is this year everything's been hammered.
Yeah, it has been. Yeah,
and so it hasn't been a safe place.
Exactly. Well, let's look at some key takeaways that we have here. So we have a listing here. Why don't we go through each one and
Sure.
just tell me real quick, because we have about 3 minutes. A bond's yield is a discount rate that links the bond's cash flows to its current dollar price.
Right. So the yield is if I have a 3% bond for $100,000 and interest rates go up, okay, that bond price or bond market value is going to go down maybe to 95,000. So that 3% yields,
Gotcha.
you know, the 4% or whatever that works to be.
Okay. And let's jump to, although a bond's coupon rate is fixed, the price of a bond sold in secondary markets can fluctuate.
Well, that's what I talked about.
Yeah. Okay. So what is a secondary market?
Secondary market is just the stock market.
Oh, gotcha.
Okay. So if I buy a bond from GM, the stock market, then I can buy and sell that bond on the secondary market, which is the stock market.
Okay, perfect. And then you mentioned all of these things earlier, so we probably don't need to recap them again. However, it's good to know because I think people really do ask a lot of questions. I know I ask a lot of questions because when it comes down to it and you're trying to really figure out everything, it's hard on your own.
It is. I met with some clients last week, and we've talked about this before. We kind of go through our accumulation stage during our working years. That's when we're accumulating our assets and kind of saving in our 401ks or our IRAs. Right. When we get into retirement, we probably ought to be moving more into the protection mode and protecting those assets because you know, losing money at this stage in your life affects you much more than making an extra few percentage points.
Yes.
And so we've been more of a conservative firm over the years where, you know, I tell my clients in the seminar, we're not here to make you rich, we're here to make sure your money is there when you need it. And so we get a fair return over the years, but if they're looking to get 8 to 10%, we're not the people to come to.
Right.
You
well,
know?
there's a lot of things that we should talk about going forward. So next time, maybe I have a couple questions regarding REITs.
Okay.
So real estate stuff.
Sure.
Because a lot of people I know want to invest in real estate given how the market has been in that too. So
sure.
Next time we'll talk about that.
Great.
All right. Thank you so much.
Look forward to it.
All right. Thanks.
All right.
If you want more information about the information we have discussed, bonds and yields, you can always get in touch with Dan at sterlingfa.com or call the number on your screen. We'll be right back.